Every economic cycle is supposed to look familiar. Expansion, excess, correction, recovery. We've been trained to expect the same pattern, just with different headlines. But this time, something feels off. Markets move faster, governments intervene sooner, crises overlap instead of ending. And the real question isn't whether another downturn is coming. It's why this one is already behaving unlike any before it. To understand what makes this cycle different, we need to step back and look at how the global system evolved to this point. For decades, the world relied on a simple engine. Cheap money. Globalization. Debt-driven growth. After the late 20th century, central banks learned a powerful lesson. Liquidity could prevent collapse. Whenever markets seized, rates were cut. Whenever growth slowed, stimulus followed. Each cycle ended faster than the last. Stability became policy. Over time, this changed behavior. Risk was rewarded. Debt felt manageable. Asset prices rose faster than wages. This was the rise phase, not just of markets but of confidence and intervention itself. But every intervention carries a cost. As globalization expanded, production shifted across borders. Supply chains stretched. Efficiency improved, but resilience declined. At the same time, governments accumulated debt to maintain growth and social stability. The system worked as long as shocks were isolated. They no longer are. The breaking point didn't arrive as a single event. It arrived as a convergence. A pandemic disrupted supply chains. Geopolitical tensions fractured trade routes. Energy shocks exposed dependence. Demographics turned unfavorable. Instead of one crisis at a time, the system faced many simultaneously. And here's what makes this cycle different. In past downturns, central banks had room to respond. This time, inflation limits intervention, debt limits fiscal response. Politics limits coordination. The traditional tools still exist, but they no longer work the same way. The fallout is uneven. Some economies face inflation without growth. Others face growth without stability. Some currencies weaken while others tighten too fast. Emerging markets struggle with capital flight. Developed economies struggle with debt sustainability. Households everywhere struggle with purchasing power. The same cycle, different pain. History offers a clue. In the 1970s, inflation reshaped economies. In 2008, leverage reshaped finance. This cycle reshapes distribution. Who absorbs the cost? Who retains optionality? Who loses protection? Modern data reflects the shift. Asset owners remain insulated longer. Wage earners fall behind. Governments pass costs forward through borrowing. Meanwhile, trust erodes. Not in markets, but in systems. When prices rise faster than incomes. When savings lose value. When policy reverses direction repeatedly. Confidence weakens. Failed fixes follow a familiar pattern. Stimulus without reform. Rate hikes without productivity gains. Regulation without enforcement. Each fix addresses symptoms. None resolve the structural cause. The world built an economy optimized for growth under stability. Now it faces instability without a growth buffer. This is why outcomes diverge. Countries with energy independence fare better. Countries with younger populations adapt faster. Countries with flexible institutions adjust sooner. Others absorb shock after shock. The cycle doesn't end with a crash. It grinds, slowly redistributing power, opportunity, and influence. The repeating pattern is clear. Debt delays pain. Intervention shifts timing. Cycles don't disappear, they mutate. And this mutation is harder to recognize because it doesn't follow historical scripts. 3 conclusions stand out. First, this cycle punishes rigidity. Systems built for predictability struggle under volatility. Second, policy tools matter less than structural resilience. Liquidity can't replace productivity. Third, global synchronization increases damage. When everyone tightens or stimulates together, there's nowhere to hide. The open question isn't how bad this cycle will be. It's who adapts first and who waits too long. Because economic cycles don't hurt everyone equally. They reward preparation and punish assumptions. If you want to understand how global shifts actually unfold, not through headlines but through hidden pressure, subscribe to the channel. Because the most important economic stories aren't about what just happened. They're about what's quietly changing right now.